Welcome back, everyone, to another episode of the European VC podcast. Today, we have Francesco Di Lorenzo. He's an associate professor of strategy in ESHIP, and Crispin Leick, managing director at EnBW New Ventures, as well as also our good friend Jeppe Høier, who is our in-house corporate venturing expert. And I can tell you, this is a roundtable where we're diving into everything corporate venture capital, how you best engage with them, how you best set them up, how you best think about the strategies, the collaboration between the VC, the CVC, and the corporate. So I can only tell you this, I think, is one of the best roundtables we've ever done. Definitely one to mark as one for you to listen to if you're VC, LP, angel, or corporate. So hope you enjoyed it as much as I did.
Here's a few words from our beloved sponsor. HowToWebConference is the leading startup and technology conference in Eastern Europe.
You're shitting me!
The 2024 edition takes place on October the 2nd to the 3rd in Bucharest.
You tell him I'll be there!
You can enter the most electric space for doing business and building technology in Eastern Europe. There you'll find 3,000 plus international attendees, 500 plus startups, 200 plus investors, 100 plus global speakers, and infinite possibilities to connect and get inspired for your next move. Venture funds joining include Creandum, Atomico, Northzone, Seedcamp, Cocoa, 3VC, Startup Wise Guys, Salesforce Ventures, Common Magic, and many more.
That's a lot more than 10 guys.
HowToWebConference also hosts Spotlight, the early stage startup program and competition for Eastern European founders, gathering the sharpest founders in the region. See you there.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Crispin, Francesco, Jeppe, welcome to the European VC podcast and a roundtable on CVCs.
Thank you for having us.
Hi. Good morning, buddy.
So this is a large one. So I think we need to just run around the table, make sure that everyone knows who's who in this call. Jeppe, let me start by you.
Yeah, I'm a former fund operator, corporate investor, and now I spend most of my time as a corporate venturing expert and consultant within infrastructure.
Yeah, and we at EUVC are doing a ton with Jeppe, so you'll hear more from him for sure. Crispin, let's move to you.
Hi, thank you for inviting me. I'm actually, I would qualify myself as an energy enthusiast, especially sustainable energy, and a little bit as a CVC dinosaur. So I'm doing this since many, many years. Saw many different models and stuff, so it's great to talk later about this. And I'm running EnBW New Ventures, my second CVC since 8 years now. And we are a single LP from a utility, single LP CVC with investor and a utility, a German utility.
And Francesco, finally, who are you? You've got Danish letters behind you. Those of the people that are tuning in that know Danish, they will recognize that there's someone here from Denmark, but Francesco is not a Danish name.
No, I'm actually Italian, and I joined Denmark more or less 7-8 years ago here at CBS, Copenhagen Business School. I'm an associate professor for strategy and entrepreneurship, and I spend my time trying to understand corporate venturing. That's what I do my research on, particularly initially on corporate venture capital, and mostly on corporate venture capital, but I'm getting more and more interested in new trends of venture clienting and partnership, M&A, and all this integrated framework. That's my bread and butter for every day. So yeah, happy to share more insights about my research today.
And I have to say, I am the same, Francesco, getting more and more interested in all the different models, because I don't think necessarily that the pure CVC model is the smartest one for most people to engage with. But we'll get into this in this conversation. let's start with the what is corporate venture capital question. Maybe, Jeppe, you could kick us off with a foundational understanding of what CVC is.
For sure. I think for us that have been in the area for many years, it's good to put a frame around corporate venturing in general, because there's a lot of strategic element into it, right? I normally call it a venture program within a corporate, and it consists of acceleration, where the corporate assists startups in their growth with advice and so forth. Then you have incubation, that is corporations starting their own startups. And then you have corporate clienting, that is very much the relationship between the corporate and the startup with respect to, it can be commercial, it can be co-creation of products and so forth. And then where we will focus most of our time today is direct investment or corporate venture capital.
And maybe from there we should go to you, Francesco. You're the academic in this context. So maybe you could give us, what would an academic say about CVC? How would you describe it?
Well, so certainly, corporate venture capital is perhaps historically the most prominent, and at the moment, still, if you look at the numbers, still the most used corporate venturing strategy by a lot of large corporations. I also want to highlight that, also SMEs, so medium enterprise, small and medium enterprises are looking at this as a strategy for growth. So basically, corporates want to grow. Entrepreneurship is the way to go, and recognize CVC as the way to tap into new technologies or accessing new market, right? So that's mostly what we are looking at, the function of corporate venture capital. If you look at general kind of a trend in the last 20 years, CVC has been established as the second largest investor after VC for new ventures. This is actually something that created even a double-digit growth in the last 5 years in many countries. So we registered recently like a high of all times in a number of investments, number of committed capital, but also number of new funds that has been created and units. And if you actually look at why firms do that, in a recent survey that I've been leading and collecting data and publishing recently, and I can tell you more about it later, the primary reason why Nordics, because the survey is basically on Nordics, corporation tap into corporate venture capital is primarily to explore innovative and specialized technologies, product and solutions for themselves, or basically looking at new innovation and new frontiers that might actually represent new trends for the core business. So in a way, the corporate venturing is a way to grow using entrepreneurship as a lever for success.
And I think also tapping in, right, it's a, we have seen some of the disruption that is often mentioned within direct investments for corporates, right? But I think we have to realize that it's also a strategic tool nowadays, and it's becoming more and more common. Europe is significantly behind our US counterparts, but sometimes it feels like how I saw, I was at a conference in Berlin back in 2010, right? And people were talking about, should you even do startups in Europe, right? Because it was something that the Americans were really good at. And I think we all know the conclusion on that. Europe is a very, very good place to do investments today and build startups.
Yeah, since this is a podcast and it's VC centric, we have many young people on the podcast, and I love always having someone who's a bit older who can say, well, you remember back in 2010, we were at a conference and people were talking about, I love bringing that context in, and I have some people that, to not put them in the same position as you, I just put you in, Jeppe, that I am so thankful that I have in my network, so they can tell me, Andreas, remember, this is how it was like, where we come from. So remember, when we now have almost half as many Series A's as they do in the US, that is incredibly meaningful. So we're coming from a very different place from where we have been before. Now, Crispin, let me go to you and ask for some of the practical examples of what CVC can do in this world.
I mean, so many things have been tried in the corporate innovation space in general in the last, I would even say 20 years. But let's stick with CVC because this is what I do day in, day out. But let me give you a little bit sort of the history of how it actually all came together with EnBW. because as a sort of corporate innovation activity, they started to really having to do something about it because they were basically disrupted in the energy markets more than 10 years ago, around 10 years ago. And they first, as a typical corporate answer, they started with what Jeppe just mentioned. They started to do, I call it venture building, but it's acceleration and then also incubation. So it's sort of the venture building piece of it, where you have internal people, you build sort of startup type-like structures in order to follow and build small businesses and to see if this actually gets you somewhere in order to make the whole organization faster and more entrepreneurial. But then what happened, and I think this happens with many corporates, after 2 years into this, it became clear that being a utility, there are not hundreds and hundreds of entrepreneurs in the own organization that you could actually get going. People talk about entrepreneurs in that case, but there were not so many. So it became clear that the corporation needs a tool to cooperate with entrepreneurs, with fully fledged external entrepreneurs. The problem is, they tick really different than a large corporation. So there's quite a bridge to gap, or there's a big gap that you need to build a big bridge. And they wanted to have also access to talent. And they knew and understood that there are many people out there that are great, but they don't want to work for them. They just don't. Of course, the strategic part or the idea of the top management was also that there are scaling and M&A options, sometimes down the road. And they wanted to get some ideas, or they didn't want to be completely disrupted. But being a utility and being very conservative, they were never ready to really throw billions at sort of a disruptive risk, but actually they wanted to just sort of have a portfolio and have pieces and little things into it. And therefore they needed a failure tolerant setup. And that means you need to build a portfolio. And this means you end up with CVC. So this is the answer to all these things. Maybe about our specific setup, which is up to today not the typical setup. And there are always sort of waves with regards to this strategy versus financial orientation, but we're a pure profit center. We have a separate legal entity, single LP, committed capital. We have our own decision bodies. We have a team incentivized on the return of the fund, not any strategic, let's try to measure something that we can't measure. And therefore, for us, the startup success is always first, and the financial return is the license to operate. Why is this so important? Because we call ourselves CVC, and I mean, there's VC in it. So if you sort of go against this business model, then you should call yourself something, but not CVC. And how can we work with the community if we have not a good fit to entrepreneurial founders, and the entrepreneurial founders don't care about the strategy of a corporate? They want to make their startup successful and big, and so you just get a mismatch if you are too strategic there. And also a fit to co-investors, because I mean, go into a board meeting of a startup and discuss and say, yeah, but for strategic reasons, we don't want to do this and that. That doesn't work. That just doesn't work. So you need to have a team that is dedicated to the startups. And that's basically us. So we actually see the possible cooperation between the corporation and the startup portfolio. This is sort of like an additional free option, and it's paid for because we deliver return, financial return. And we never try to force this cooperation, because if you force either the entrepreneur, you need to work now with this corporate, or if you try to force the corporation to work with the startup, it ain't no good.
And Crispin, you are a CVC specialist, right? So we have talked quite a lot in the past, and also me trying to get my hands around what I've experienced in the past. But going back in time, right, what have you been most proud of within EnBW, and maybe where you have struggled? Just one example of each, right, at this point of time, because we'll get back into it.
Yeah, probably we get later to other things. But honestly, I mean, I think EnBW never expected that we saved the world for them. Yeah, so that was never the expectation. And I think this is a difficult expectation. If you start a CVC and you think, okay, they will save the world. What makes me really proud, and this boils, of course, into the business model, and this is why I'm heading the unit and not someone else. In the last 3 years, we have delivered well above hurdle rate returns every year, and we've done every year exits. We have also one exit to EnBW, so 100% takeover of one of the startups, which is, of course, the thing where, well, if you manage that, then you add value to the organization. And how did this happen? Well, basically, it's about business models that are either too small or not profitable enough at the very early point, where then sort of the corporate would say, I don't care right now. But when they care, it's too late, or they have to buy a company for a huge amount. And they have to pay market prices if they buy one of our startups. That's clear. Otherwise, our business model wouldn't work. But of course, as we are 100% subsidiary, if we own already 15 or 18% of this unit, of this startup, then of course they have an average in price, which is much cheaper if we were in early. So what makes me very proud is that half of all of our startups are actually commercially cooperating with EnBW. And not because we forced them, but because we try to invest into business models and into topics that might have an impact on EnBW. But let's be clear. I mean, EnBW is an entity with 28,000 people. Last year 6 billion EBITDA. So so getting an impact on that one, we're still working on that.
Yeah.
I would love, because you asked, or you didn't ask, you said something controversial, I think, Crispin, because you said that we have a carry component in our structure, and it's the only way. If you want to play in VC, you got to have that. And that made me just ask my good friend ChatGPT, what's the numbers on this? And what I could find was that according to PitchBook and Global Venturing, around 25 to 30% of CVCs in the US offer carried interest, but in Europe, it's only 10 to 15%.
Yes.
I'd love to ask the three of you to riff a bit on the carry point, and maybe particularly force Jeppe and Francesco to take a stance on the Crispin statement that it's the only way you can really do it.
Maybe I add just one piece.
Yeah, oh my God, are you going to caveat it?
I said this is the only way. I refer again to the VC business model. So our sort of, when we talk about our talent that is working for us, this is people that want to do venture capital. Yeah? So what I've seen in my first fund that I was managing, we had not this strong incentive. We had it for the managing directors, but not for the team. I lost my best people. I mean, some of them are now partners in other funds. And if you don't want to lose the really good ones out of your team, you need to be competitive on that end. Still, you need to look for people that still like the C in the CVC. Yeah? So that see this advantage of having a large organization with many experts, with a lot of know-how that they can tap into without sort of having to go to external advisors or I don't know what. So the talent and the fit to the business and sort of trying to make your portfolio happen, work day in, day out. If you have a corporate contract with paying overtime and I don't know what, and hundreds of days off, this doesn't work.
So I guess this very kind of full of different perspective conversation about the carry interest and return on the investment make me probably invite the elephant in the room, which is basically the balance between the strategic versus financial return of this CVC unit. And this is actually a very, very under-discussed, I would say, topic in the field. One of the reasons why it's under-discussed, at least from an academic perspective, I know the practice is actually much more active into this discussion, at least in those rooms where people can raise the voice and yell and find, obviously, the truth of the usefulness of CVC, right? Basically, for us, for academics, it's very difficult to understand this topic because it's very hard to know the initial orientation of any fund of any unit. So the data available, financial data available, even the most complex and rich that I have access to, we don't really know actually unless we ask what's the orientation of the unit. So that creates a lot of bias, let me say, or at least a distortion in how we measure success. So at the very least, there are few attempts, right, that have been trying to map, mostly to survey. And the survey basically suggests that the primary orientation of a CVC unit is either purely or mostly strategic, right? But again, from strategic, what does it, as opposed to financial, right? So strategic, again, let me return to the point, means accessing new innovation, having these windows of new technologies, or accessing new markets, typical of fintech, for example, right? So in that sense, I don't think the conversation here, my view, is not much about strategic versus financial, and therefore the carry interest as a way to incentivize the financial returns, right, from the managers of the unit. For me, it's more about how much is the risk tolerance, or how much low or lower returns the corporate, the parent company is allowed, or itself, or in general tolerate, to return on CVC specific investment, right? Because if there is a strategic nature, that must be also coupled with more flexibility and tolerance, let me say, on risk and returns. Does it actually happen? Well, actually, talking in the beginning with the unit managers, that happens. But when it comes, as actually Crispin will also say, after a couple of years, 3-4 years, let's remember that the life cycle of a CVC unit is very short, too short, in my opinion, to create value. So that maybe after a while, the strategic goals are a little bit maybe put aside, or toned down in the light of, okay, but now we have to return also on the fact that we put some money on the table, and that made some demand for return. So I think, again, for me, it's not a much either or. CVC, in my views, are established to reach strategic returns as first. And then the point is, what's the tolerance for risk? And that's obviously varies, of course, also in economic cycles, where first we actually have more pressure for cashability and EPS focus, rather than just growth and scouting opportunities. But for me, it's a tolerance for risk, not much the conversation about strategic versus...
I fully agree with Francesco here, right? Because this is a matter about the principal agent model and incentivizing the people. So when we talk, corporate venture capital, I'm also in agreement with Crispin. If you do not have carry in a CVC, you cannot keep and attract talent. You will not be able to do what you're supposed to do. What I think comes a lot into play here is that when you look at these big corporations, it tends to only be in the financial sector that someone that is not the CEO can make more money than the CEO, right? If you are a trader on a floor somewhere, you can make a significant amount of money, and that is because you take the risk. But a lot of corporations are not, especially not in the sectors that Crispin and I came from. They're not risk willing, right? If you take risk, there's a chance of people dying, right? So it's kind of intuitive that you don't take the risk, but that is also why you do CVC, right? That is to understand, to take the risk. So it is, for me, and what I always talk about, it is, before setting up a CVC, you need to understand what it is and what elements are inside of it.
So if I want to give a number, in the recent survey, the first wave of survey on the Nordic CVC activities, 61% of the respondents, you're talking about large Nordics firms, declared to be purely strategic oriented in their CVC activities, and an additional 26 to be balanced between strategic and financial goals. So this left basically 13% that in somehow is purely financial, right? For me, this is a 13% that I would really like to understand better, because what does it actually mean is curious in that sense.
I would love to put a little bit another flavor on this, because if you would ask me like strategic or financial, my answer, to your big surprise now, is and. It's an and. Now, but let's go one level deeper, because how do you set this up? How do you do this and? From the corporate view, if you would ask top management, 100% agree. The answer is, we have created the CVC, and this is what I said before, for strategic reasons, out of the view of the corporate. And then comes the big next step. Is the corporate deep enough, and especially the top level management, deep enough into understanding the different innovation business models, especially CVC, to choose a setup for the CVC, which is purely financially oriented, and you only bring in the strategic piece into the investment strategy, but not into the individual decisions on the startup. You're not forcing the startup. For example, the startup comes up with and says, hey, here market fit doesn't work, but here's another market fit does work, but that's not a strategic market anymore for the corporate. Well, if you are on the cap table, you have to support the startup to be successful, to make money, to grow. So you cannot just say no. Well, it doesn't fit to the strategy of my corporate. This is why I don't support this. This doesn't work. So the CVC unit has to be purely financially, but within a frame that is set by the corporate in order to achieve his financial targets. And this is where always sort of these mixed structures, where sort of people are responsible for the CVC, that are also doing strategy or are also doing this is very difficult, at least in my experience, because the CVC setup must be sort of as sharp and clear as possible. And I circle now back to, otherwise you're getting not the best founders, you're getting not the best co-investors, you're getting into a spot where, more like in a joint venture spot, where you can do some strategic joint venturing with other corporates. But that's not VC. So, and as a CVC, I would also argue, well, we know and we don't try to be the best of all the VCs. Yeah, I mean, there are VCs out there that know extremely well what they do, but we have a special bridge into the corporate. So we know the pain points of the corporate. And therefore, we can offer something else into the cap table in order to create value for the startup. And if we do it right, automatically also for the corporate. But so I think this understanding of not saying, well, it's an and let's mix it all up, but really to say, okay, the corporate for strategic reasons, but the CVC unit is a financial return oriented. We want to have successful startups. If we don't have successful startups, it doesn't make sense to let them cooperate with the corporate, because then we have a lose-lose and not a win-win. So, and this is the funny thing that I always go this one level deeper, and it's very surprising that still 80% of the CVCs are not set up like this. So maybe I'm wrong, probably, or well, it still needs to evolve. I think the whole CVC area is professionalizing a lot in the last years. And that's really great, because for me, like in the early years, it was really difficult, especially in Europe, because even and there, I mean, if a corporate would talk to me and say, hey, we want to create a CVC, I would first say, okay, let's talk about to all your board members and let's ask them, do they know what CVC is, how the business model ticks, what they need to accept, how it should be set up in order to be able to be successful. If you're doing it wrong, it cannot be successful. It's not a failure of the manager of the CVC unit, but of the setup. Yeah. And so for our case, just to be in sort of the real setup again, we report into the CFO. To make crystal clear, license to operate is return. By the way, this is also a lot of pressure, because there might be also some teams out there that are quite happy with their corporate contracts and being in the innovation thing, because this is a huge pressure. You have to be successful. And the second thing, I was really lucky in the early days in EnBW, they have put me into the top management group. I mean, I had 0 employees, and all these guys had like thousands of employees, and they put me in there like a wild card and said, if you want to do your job successfully, you need to understand how this thing is ticking. What are the pains of the operational guys? And then think about if there's something out there that could help at the end of the day to get the scaling. Yeah? And this is difficult to find. Yeah? It's not because the corporate is so different.
Could you share also who took the decision of creating EnBW Ventures?
Yes, it was actually at the time, interestingly enough, it really came out of the innovation management. So as I said before, they created first the internal innovation venture builder. And they had the chief innovation officer basically said, we need another tool. And then there was a big discussion within the corporate about, okay, so the finance side, of course, said, okay, you're now asking for 100 million euros. I want to ensure that there is a very, very strict financially driven view on this. We will not put 100 million into the startups and hope that it somehow works. So the finance side of the business was not ready to do this in the innovation structure. And this is why then the separate unit was formed. And this is where sort of discussions with me started at the time.
I think that is super interesting, right? Because oftentimes we see kind of the innovation part coming out of strategy, right? I've talked to many CVCs that got started this way, and also we have spoken a little bit about it previously on the show, right? That you also have the J curve within CVC, right? Because you kind of have a 3-year period to be kind of financial successful. And it's difficult in the J curve, right? But if you're lucky enough to go through that, kind of the next gate of a close down is lack of strategic match, right? And that is where you have all the collaboration, the KPIs, all of that. And then you might get lucky and get into year 10, right? And then you are in pure survival mode, right? Then you are there to stay, right? Because then you have kind of contributed to that. But also, a lot of the corporates that I'm talking to, right, they did not make a plan. Like you said, right, it actually sounds like EnBW was on top of it and kind of had a process where they talk through, how are we going to be successful in this? And also from, both a financial and strategic perspective.
Yeah, the chief innovation officer at the time actually went out to the market and was talking to practitioners, to CVCs, but also to investors, to founders, and so on, to understand how does this work. And there was the clear emphasis: let's hire someone who did it before, not trying it for us, our own, for the first time. And I think what is extremely important on day one of creating a CVC, as I said before, like talk to all the board members and understand what are they expecting, have they understood it, and get access to top management. And the third thing is you have to understand really well the core business of the corporate, the core business model. Because if you want to think about how can I actually leverage, how can I support them somehow without forcing it, and I had, like, before that, 15 years in the utility business. So I know all the different value chain steps in this. I didn't need to learn that. So understand the core business well. And for us, for example, our investment thesis from day one was the utilities investing into infrastructure, really billions into complex, large-scale infrastructure. So we said from day one, that's not for us. Yeah, we also don't want to do deep tech because they are technology agnostic. Yeah, and they are a late user. They are not trying something new on the technology end. So what do you do as a VC investor with such a corporate backer? And for us, it was clear from day one, okay, let's write it down. We are looking for startup that in mostly digital business models are improving and scaling this huge asset infrastructure rollout that they need to accomplish with the energy transformation. So for example, battery rollout. Yeah, well, they need to build many, many batteries, but this is a new asset. They don't know. So we have an investment into one company that is actually intraday trading all these batteries, and another startup that is actually monitoring all the data of the batteries and ensuring that the battery is in perfect health. So you improve the business model, the operating business model of the core, but you're not stepping on day one on their toes. And you're doing something that is digitally scaling. So you're not in this death thing of let's do deep tech for the next 20 years, because the utility will not wait 20 years with your CVC approach. So think about this thesis on day one. What is it? And it might fail, but at least you can say, okay, this is what we're trying to realizing here. And there must be the buy-in, not of one board member. Get the buy-in of all the board members. In order to get, you said 3 years, I think you need 5 years. If they are not willing to give you 5 years to prove the point, it's very, very difficult.
Yeah, but it's very interesting, Crispin, that you talk about these 5 years. I'm very curious about, is that even possible? In the sense that I could see actually examples of very regional or international players that have been in the last 5 years changing 2 or 3 times the view on the CVC. So if you want also the investment thesis behind, and still be successful in that change. And that change because of the change in the corporate core business view on where the value creation was done, basically from upstream to downstream. And then you can see that you maybe have someone coming from this operations maybe at the beginning, and then someone more close to sale later on to lead the unit. So do you see this as something that is somehow creating more friction, the benefit, or is actually an optimal response to the dynamic that actually a business can have?
I think it is very, very, very difficult to build a CVC where you have every 2-3 years a different investment strategy. I mean, I've seen this from a couple of large energy players, oil and gas and so on, also from some others. I think you have to think about your investment thesis in a way that it should be good for a little bit longer than 2-3 years, even for the corporate. Yes, the corporate is changing its strategy, but for example, one of our core part of this we had megatrends, and we said, okay, we only go into electrification stuff. We don't go into all the other things. That's old stuff. We go into the new stuff, electrification. We go into digital solutions, because we felt like, okay, this big organization, the people that are very first digital and are really developing new things, they're not really the typical sort of first one to say, I want to work for a utility. So you need to make a little bit the gap analysis in order to help the corporate really. And I think it is very different depending on, we have a utility. I would maybe say an insurance or a telecommunication is maybe a little bit the same type. But then if you are an OEM, that's completely different. If you're developing hardware technology, then of course your CVC will look different and will have a completely different proposition. And if you are an IT digital company, it will be different again. So what I'm just saying is do this in the beginning, and it should be good for quite a while. We are reviewing our investment strategy every 4-5 years. But the changes have been absolutely minor. And there's also this thing, like you are in the startups and you should not lose your interest in making them successful just because the corporate is a little bit changing the strategy. So there comes again the financial orientation. So my team will fight for the best value created.
I think what is interesting here, right, if we take the helicopter view on CVC, right, and also what Crispin said earlier, right, it was kind of a CFO decision. When you take big corporates, they are measured on the basis of their annual report. It's a 12-month cycle. And when we discuss, startups and the world of funds, right, we're talking about, at least 8 years to build a startup. And most of the VCs that I know about, they're going into 14, 15 years before they have closed the full cycle. So a board in a large corporation that understands that this is a strategic tool can help put it in place. But if you ask a CEO or a CFO in a company to allocate, 50 million euros, or in your case, 100 million euros, that could generate profits in other areas, remembering that their bonuses are based on a 12-month cycle, right? They are just things that do not add up. And then again, if you are a listed company and look at the stock market and the financial analysts, they don't hardly give you any value for driving a CVC. So there's something in the market that does not fit with corporate venture capital. And then remember, a lot of the startup IPOs that are done, all the value is based on the promise. And that is super interesting, in my opinion, to bring that into play.
I think there are solutions to the issues that you mentioned. The first thing is the size. So if you start with 1 billion CVC, you get under pressure. If you like EnBW is investing 40 billion in this 10 years into their assets. For them, if we invest in a year 10-15 million, that's like one offshore foundation or so. So it's really small. So this is where you buy a little bit of time. So I would suggest don't go big on day one, but go big when you have proven your case. So that's one possible outcome. The other thing is most of the corporates are not, it depends, but they're not so much cash driven, but result driven. And if you build a portfolio which is not a seed portfolio, but sort of a little bit like Series A plus, the probability is pretty high that your J-curve is there, but it won't kill you, and the losses will be not as big. And as an investor, you invest, and yes, there's a cash flow that you need, but you're not negatively pushing down their results. So there's not always this contradiction. And yes, I must say this was just lucky that I'm working for a CFO that from day one just absolutely understood what we're trying to do, why we're trying to do it, and what effect it would have on the corporation. And this is definitely, this doesn't happen very often. So that was pure luck. And what was even more luck is that this same CFO, we are now in year 9, and he is still the same. So the whole board of EnBW has changed. There were 4 board members, like 3 have changed. 1 is still there, and that's the one that is actually our link. So this is all sort of, you have to be lucky also on the way. on the way.
I was wondering, Francesco, I can't remember. Do you, from your study, look at who does the CVC refer to? What is the reference line? I can't remember.
Pulling out. I was actually about to give this.
I'm looking forward to this because I asked ChatGPT the same question. So I have other numbers that we can compare here. We can do some real life comparison of AI here.
Okay, don't I feel the pressure of ChatGPT as the actual knowledge creator.
Well, I have sources. Mine are PwC and PitchBook and Global Corporate Venturing.
No, absolutely, Andreas. So I was actually pulling out the numbers. Again, these are numbers that are, very, very difficult to observe. That's why I took this initiative a few years ago, and I'm pushing forward to creating this Nordic Nordic survey to understand at least how it works here. So in the Nordics, at least, basically, so the units are average size like 7 people, more or less, and they tend to report mostly to the CEO, and while being the CFO and the business development unit second in rank. So at least in the region, it seems that the unit reports directly to the CEO as being very strategic. In fact, so speaks very much to the strategic nature that I was telling you before. When it comes to the type of employees, right? Crispin was actually, and also Jeppe, where you were discussing a lot about attracting talents, where the talents are coming from, and with the people that compose this unit. Again, from the survey, I can see here that 50% usually come from business development, and there is another 44%, which it doesn't sum up. People can come from different units as well, to the R&D. So basically, 1 or 2 in the unit are not necessarily from the financial background of the core, okay? And they try probably to bring those skill and capabilities needed, right, to push forward the activities in the unit. I just want to say another couple of things again. One again from the numbers. At least in the Nordics, 40% of the responded expect returns not before more than 5 years, and this is also their basically investment horizon. Okay, so they seem to be very patient investors in terms of when to expect returns from those activities. Right, and so this speaks maybe to a Nordic way of doing investments. I understand from the conversation that Crispin and Jeppe had before, especially the experience that Crispin was bringing. Maybe there is a little bit more a faster pace, right, in looking at returns and investment horizon. But the Nordics at least seems to be a little bit more patient. One thing that I want to bring
let me keep you on that point, Francesco, because Carta just came out with their data recently, saying that basically in year 5, that's where we're starting to see a little bit of returns, but it's real cash on cash returns, DPI, but it's so minuscule, right? And typically it's actually the less good funds that return money already in year 5. So I would think, and I'd love to ask you this question, Crispin. Year 5 is not a good year to expect to have anything meaningful, not just in the books, but in hand. What's your reaction to the number that Francesco shared there?
The first thing that you can prove, and this is what you can try to prove also much earlier than actually your cash on cash exit, is I think a CVC investor is smart, or in my personal view, it would be smart if you label yourself as a growth investor. And this can be measured easily. Are your startups growing? Are they advancing? And here, just to give you 2 numbers, our expectation for each individual, we're not VCs, so we're not expecting 300% every year. We're expecting 100% per annum of growth for each from our portfolio companies. And there we had years in the last couple of years where the average of the portfolio was hitting that. So all of them on average around 100%. But what we need to have is 50% growth on average. And
what are you counting their revenue or?
We are, second piece. So 50% is what we need on average. And this we have hit in all the years since we have been established.
Is that valuation increase or what increases?
No, that's the growth that is important to us is not turnover, revenue, top line, but we are looking at gross margin, gross margin contribution. This is what we're looking at. Why? Because all the other stuff down the road, how do you want to measure that? But that is then also a question of the investor. Yeah. So we are typically investing B2B digital business models. So there you can measure it like that. Maybe others are doing it different. But we're using gross margin. So we want to have high gross margin businesses, and we want to see that the product is that, how do you want to measure product market fit? By the pure, top line growth is of course nice, number of logos and customers and so on. But also sort of we really look at the financial numbers and of course at the sales pipe and so on. And we do customer reference calls and I don't know what. This is why I would always argue doing seed investments, and many CVCs are doing seed.
Jeppe, I'd love to ask you that question because we've had this conversation before as well. And you also said, I think Series A is the best place to put yourself as a CVC.
It's quite easy to do a pre-seed or a seed round, right? It doesn't take a lot of effort, right? Because you don't need that big of a match with the corporate strategy to make it happen. You can talk about, this is going to be good in the future. I've done investments for Maersk in last mile delivery, right? And, Maersk is about moving containers primarily, right? So why would you talk about moving something on a bike, right? So I think when you want to be part of the strategy of the corporate and be meaningful, you need to go a little bit later stage. So I did an investment on behalf of Maersk into a company that is doing autonomous electrical trucking. That made a ton of sense, right? Because it was the green transition, lower emissions for Maersk. Also, the autonomous part with time, knowing how difficult it is to hire a truck driver. It made all the sense, right? And that was a Series B2, quite a significant investment for Maersk growth at the time. And then on top of that came a very, very large commercial agreement between this growth company and Maersk. And then everybody around, the CVC kind of saw what you could do, right? And that is where it's meaningful. But it was also a board decision to do that investment, right? It was not something that we could do in the CVC.
But that's the thing, Jeppe. I think the key word, I think I know the operation I'm talking about, it was very well discussed in the Nordics as being one of the largest, right? At least in the region.
Yeah, you can mention the name. It's not, we've spoken about it before in the podcast where it's public. So Einride, right?
So I want to stress something about what you mentioned to me, very important, which is the commercial agreement, the follow up. So I think if CVC wants to go into later stage, which implies obviously double-digit million euros investment for every round, or triple at some point, if you're talking about really big scale up, the commercial agreements, so the contractual perks attached to the investment are fundamental. The recent study that I've been doing on pharma and ICT, the last 20 years, I've been looking at a very one-by-one investment, and because having contractual agreement data is not really available in data sets, so you have to go to news and basically go and check one by one. So it took me a lot of time, but we actually discovered how many the kind of a strong correlation between having later stage investment from corporate via the CVC and the licensing, co-development, and commercial agreement attached to the investment as a necessary condition, in fact, to make the investment going through. So I think what you're pointing is something which is what we all basically are saying here, is that the return, the financial return, right? So that will happen through a commercial agreement, also speak to the strategic positioning of Maersk in this case, in the new segment, which is e-vehicle, EV tracking, right? Which is extremely important for the future. So they go hand in hand, and this is what I would like to see, right? The discussion also we had before. So additional contracts are fundamental for the success of later stage CVC investing, in my view.
The interesting thing is that this is a very, very difficult spot. Why? Because if you mix up things, then you land exactly in this area where, well, you tell the startup, okay, you get the big corporate contract when we can invest. So let's get a better price, or let's get some advantage, or let's get some exclusivity, or I don't know what. Or the other way around, the corporate might go to the CVC and say, you're invested. If we are doing a big contract there, what do we get? What do we get for free? A better price? Or can you tell us what the margin of the startup is? I don't know what. You get into a very, very, very difficult spot. I call this conflict of interest because it's a huge one. And if you want to be a successful CVC, you should try to avoid this conflict of interest as much as you can. Therefore, I would always suggest, and there's of course, as always, there's a problem, but there's a solution to it, because your point is 100% right. It is very, very important. And that's, by the way, also one of the unfair advantages of a CVC, that there could be this cooperation, that there could be growth coming from the large corporate that you know very well. So it's like you have an insight that the others maybe don't have. Yeah. And I mean, many of our VC friends, they call us because they want to understand. So how is your corporate looking on this? Yeah. So how we have tried to solve this is that we're strictly saying as CVC, we open doors, we moderate basically the contact, but we do not mix into this. Commercially, we don't go into this negotiation, and we never connect it hardwired to any investment. And so we take our risk, which is the equity side, and the business units decide if they want to work with this solution. But of course, indirectly, there is higher probability if we're invested that we can moderate and help that something happens. And there's a higher probability if EnBW is working successfully with a startup that we might call the startup and say, cool what you're doing there. Our friends from the operational units have told us you have a great product. It adds a lot of value. When is your next funding round? Let's talk. So, but if you connected, hardwired the valuation with a corporate commercial contract, that is very dangerous. And I think also for the co-investors and the cap table. So again, there is this, you need to really think how you do it, but it's core to solve this.
Maybe to give the listener a little bit more flavor, right, and disclosing a little bit that I'm allowed to disclose, right? So I think at Maersk, right, we also always had this rule, right? The pitch decks that we receive, they belong to the CVC. They do not belong to Maersk. Just to make clear that that's how it was operated. Then we had a special team that was more, we call it portfolio management. And it was more the people that took care of the glue between the startup and the core Maersk, right? So it was people coming out of Maersk, the Maersk consultancy business that did all of that. But I think it was huge to get it to work. And then I think what the listener could benefit from, right? I missed 5 board meetings in Enright as the commercial discussion was going on, and it took 6 months or so, right? So it was for a long time that I left the board and did not get any information because the VCs around the table, they needed to discuss how to handle this commercial collaboration. And at the same time, as an investor, I didn't get stuck in any bad situations where I could deliver information to one side or the other.
We have actually it's only not even 3 years ago, and this I've learned from other CVCs, because, I mean, you have already heard that our setup is quite strict, but there was something missing, because my team is very small, and day in, day out, they're thinking about the startup, about the next deal, buying, growing the startup, being in the board meetings, selling, so this is we're a transactional team. But who has then the time to actually moderate and open the doors for a possible commercial cooperation? And this is why we've actually started, it's a very small piece of the team, but we have someone in the team that we call engagement management, who is not working on the transactions, and that's not only in the direction of the startups to understand what is their sort of, who maybe also to other corporates, who could we open doors, but it is also walking around in the corporate to identify pain points, to say, hey, something is really not working there. Could there be a startup that actually could solve this? So it's also input for the transactional team to say, hey, I've seen this and that. And this is then sort of, because getting the timing right is extremely difficult. So you could have a startup that is great, but it's currently no pain point, and it takes 5-6 years until it is a pain point for the corporate. Then you are too early. Or the corporation has already decided that they're solving it in a different way. Then there's also no cooperation. So that's also not great. So yeah, we call it engagement management.
Can I ask you guys, because we have media for growth strategies where the media conglomerates are investing basically ad points, so spend on their ad machine into companies to whom that would be valuable, and they do that at some currency exchange, so to say, into dollars. And then in the US, very significantly lately, we've had Amazon, Microsoft, Google all investing chips, so to say, or AI power, the ability for the large AI companies to go in and use their servers. How, I get 100% what you're saying, Crispin, that, there's a big conflict of interest here, but at the same time, there's also a big opportunity, and kind of, I get that why you've decided to say, no, we're not going to do it. But I also definitely get the ones that say, no, this is too interesting territory not to go into.
Yeah, I think when you're getting this big, it's a different part of the game. And I would say then you need to talk to your M&A team, and you should think about, because then when you want to have something so much and you're already sure that it is hugely important for you, then you should go fully fledged ownership, control 100% or 80% or at least 51% and buy something. So it's just a different avenue than CVC, where we have a portfolio where we take higher risks, but we're not yet. As of today, we don't know. We think it could have an impact, but we don't know yet. And we don't have the crystal ball to be sure. So it's just a different approach and a different tool.
But that's probably why there is we come back to the beginning of this rich conversation about the different models. So then the CVC cannot fits all, where all means all the objective and the way to operate. So I think we've been discussing for quite some time before. We don't mention it, the venture client model. We solved a lot of this commercial agreement, right? And the M&A division is exactly the one, as Crispin said, that should take over when the importance is so fundamental to be part of the core. So I think it's very important to see the CVC as probably the strongest weapon that at the moment has been built from corporate to deal with ventures. And that's also what the data suggests, right? In terms of how much capital is committed and how much people are committed and so on. But in the latest few years, especially right now, the conversation is really about what are else there that we can combine with CVC or instead of CVC, right? In order to keep pushing the same goal, which is growth.
But I think one of the things that when we started to contribute to the strategy of Maersk, right, was when we I think it was in 2020, there was a strategic insights team created under Maersk Growth. It was a real analyst analyzing the startup kind of community and finding relevant areas to introduce to the C-suite. It could be anything autonomous, right? Because that was huge, right? Anything that could transport itself. So when we started doing these 30, 40 page reports, they started to listen, right? Then we brought value to them. And that ties into what Francesco said, right? Strategic decisions to do a CVC from a start, right? And then how do you deliver on that? But I think, and also Crispin, you were on top of that, right? It is the KPIs. What are the KPIs mentioned and agreed upon for the CVCs to be successful? Mm-hmm. And then everybody is in agreement around the board and the C-suite of the success of the corporate venturing entity.
Yeah. In our case, actually, there is a strategy team and there is a transformation team within EnBW that are really discussing the big topics. And we have just a close link to them. So to bring the sort of startup perspective or investor perspective, what we're seeing in the markets for them. So we're not sort of giving them, this is the big strategy, but we're more like reflecting on what they think is the big strategy, what we see in the market on the investment side. And what you mentioned here before, Andreas, with your question, also to the M&A team, there has to be, and there should be, a nice connection to the CVC. So the M&A team, if the company is still a little bit younger or smaller, and they think about, okay, what do we do with it? Should we engage or not? We're very close to them. So because the probability is very, very high, we're running since over 8 years, that this company is in our database and that we have seen, even though we might have not invested, but that we've seen a couple of the rounds that they did before. So we can give them history, we can give them our understanding of what we think about this company. So in that sense, there should be an exchange to improve also the other functions, but always geared towards sort of what we know from the startup world and the startup market and what we see in this market. But we're in the market. We're not a strategy team or anything like that. And we don't qualify. We would never say we know better and we'll save EnBW. No.
I think there are two topics here that it's very fascinating just to, conceptualize some of the things that we are, if I may, right? So to kind of have been discussing. So on the one end, there is this idea of kind of a supply versus demand-driven CVC activities. So where, the supply side would be kind of having a strategy, right? Somehow that's what I want to position my company. It could be again, EnBW in 5 years from now, 2 years from now. So please go, guys, and work for it. And guys means everybody, including the CVC unit, right? Or it could be more demand in the sense of demand of fund in this case, right? So the startup world can say, well, I set up the unit, go there and see what's going on, right? So I can clearly see, at least from anecdotes, right, that the second one tend to be a little bit less successful and more costly, and eventually turn down much more sooner than the first one, because there is a backup from the other strategy, right, of the general core. That is one thing. So I think corporate, especially the ones starting, have to understand how they want to deal with this, right? Because the second one seems to be more like a VC type of job, right? But have the money for doing that. Corporate don't have those funds for doing that, right? The second point I think is very dear to me, and is a message that I very much want to promote. At least that's what the research that I'm doing and other scholars worldwide are suggesting. Eventually, all the results speak to the fact that the CVC is defined as minority investment in young venture or young entrepreneurial ventures by incumbent firms, right? But it doesn't stop to be, and probably is mostly like a strategic organizational tool. So not having the governance, let me call it that way, right? The Crispin you were somehow referring to. So the idea that the M&A department should talk to the CVC department, and in general the operation should have a say about what do they need, right? I think this coordination, let me call it governance structures, right, should be at the core of including the board, up to the board, right, should be at the core of the discussion or when setting up and how setting up a CVC unit. And even if we set up, how do we want to run it? So my understanding is that these governance structures, at least from the data I see and the talk that I have, is among the problems, number one, when the unit goes in trouble, when it comes to be terminated or be less relevant or be less impactful. Because it probably less kind of communication and coordination effort by the different actors, right, to make that activities of investing in startup very, very, very important. So I think this is something that is tend to be forgotten too frequently, in my opinion, in the light of putting a lot of emphasis and attention on the investment element, right, rather than governance structure and how we actually train our employees to think entrepreneurially while they actually deal with startup is a little bit less forgotten. In that sense, I want to mention an example. There is a company that I've been talking to recently before vacation. Is A2A is a utility company in Italy, right? And they set up a CVC unit as well, but in a hybrid way. So they basically became LP for a VC that then functioned as a GP for them. So it's a kind of like, interesting hybrid model, which is also adopted by a few other firms, including here in Denmark, right? In which basically they say, you know what, the investing part is very complicated, and returning on investment is also a matter about knowing finance, right? But I know what I want. I know what I want to position my corporate in 5 years from now. So let me focus on that, right? So maybe, and this is a question somehow, maybe the separation is a new perfect equilibrium here to search in the new design of CVC unit. But everybody focuses on their own core skills, right? The operations or the operational element, the strategic, and the financial part is actually given. I wouldn't say outsourced, but in some level, right? And I can see firms going that way. So we'll let you know, guys, how do you see this? And it's something that is promising.
But I think it's a lot about the decision gates, right? It is, there's a lot of literature also on, should the CVC sit at headquarters or not? Question mark, right? Because it's more, do you get influenced by the normal way of running a corporation with everything included? Because one thing is for sure, our VC counterparts, they do not run corporations, right? They run investment teams, and it's all about returns, right? So I think also, when you look at studies around, how much time does CVCs use on kind of normal management, and that goes from 25% and up, right, in some cases, and that is a little bit crazy, right? So I think that there are many models.
Well, maybe I go a little back in my history, because I think there's basically no operational model that I've not lived through. So when I started the first, 16, 17 years ago, the first CVC for another utility, not EnBW, we were first starting as an internal unit. They had a lot of money to invest. So they wanted to do crazy things. Then a couple of years later, they had no money, of course, anymore. Being an internal unit, even though you say before, you need 10 years. So no money anymore. Then we did a spin-off. We took an external investor in. So we had a hybrid investor structure. So being partly CVC, partly with a bank as an investor. Changing the name. So being a fully fledged GP-LP structure. And then CVC became back en vogue, and that meant that the large corporate wanted to continue in a more strategic and standalone way, which of course was not possible for us anymore because we had these other investor in, and we had keyman clauses and so on, very professional setup. So this didn't work. And then finally, after a couple of more years, I started the second CVC here in EnBW, and thinking about what is the real advantage of the CVC, and having seen what happens if you're not part of the family anymore, then it is, in my very personal view, impossible to get the synergies right. And we do also fund investments, not just as part of our mandate to do some fund investments for the community, for deal flow, for making our direct investments better. I think a corporate that is trying to be LP in a VC fund will fail, because they have no clue how the VC business works and how does this all tick and so on. So it's very passive. So on the day where you have sent your commitment letter, the GP does what it does, and they don't care at all about what this corporate thinks. They still talk to the corporate in order to get strategic insights or something, but there is no synergy at all in order to figure out where are the pain points of the corporate and how could we help. Because as we said before, the VC just doesn't care, and he shouldn't, because he's 200% just on return. And therefore, so for us, it's a great tool to do the fund investments in order to be better involved into the community. And we learn day in, day out. And we also learn that we tick a little bit different. But the little unfair advantage that a CVC has gets lost, in my personal view, in such a hybrid model. But I guess, Francesco, as I'm running a CVC, you would have not really expected me to say, hey, let this do external VCs. So I'm a little bit biased. So sorry.
I understand. That's what I'm saying. Is an upcoming trend. Has not been yet validated to be
And I think for smaller corporations, I would always suggest don't set up your own CVC. You have to have a certain critical size because of its complexity, because of the readiness to lift this business model and to let them do it also. If you are smaller, you should really invest into other VC funds where the investment thesis gives you insights into what you are planning or what is disrupting you eventually. So it's always like a mix, and this is what I said on the very beginning. Every corporate should analyze what they want.
But Crispin, on that note, right? So what would your recommendation be if you kind of had 20 million euros to do something within CVC?
It's subcritical. I would not set up the own unit with 20 million.
No, but would you then do some kind of hybrid model? Maybe, do an investment into a VC as a service partner or something like that?
I mean, I'm not 100% up to date with the VC as a service. I saw some of these companies 5-6 years ago, and they were incredibly expensive, and they were paid deal by deal, so completely wrong incentive. This was not a cash on cash because I strongly believe in cash on cash, not in someone makes some calculation and says they are successful. So therefore, if there is the 20 million, I mean, I think the corporate should then really think about, if I do an LP investment, do I have people in my organization that get me the benefit out of it, that are dedicated to look on the reports, to meet with the VC, to really offer this strategic insights to the VC, but also connect and understand the investment thesis for every single investment from the VC, in order to take this with you into your strategic meetings and discussions. If you don't have these people, and this cannot be someone who does 100 other jobs and then has 5 minutes to deal with that. So I would then take the 20 million and split it over, let's say, 5 VC LP investments, and really having someone in the innovation department, or I don't know, to really take this know-how and learning and to the benefit of both the VC and the corporate.
I think you're completely correct there, Crispin. I just pitch in on this one because we're investing as LPs ourselves, my co-founder and I, and then we've helped a bunch of emerging managers get off the ground and think about their fundraise strategies and so on. After 350 or so interviews as well with VCs, I kind of have a feel for what are people's fundraise struggles. And in Europe, they're massive, right? And that would be my core point here, that any corporate that could bring even 1 million or 2 million as an LP commit to a fund, as long as you're not talking the large funds in Europe, but anything in the neighborhood of 40 million, which is a very good segment of European seed funds, you definitely have a meaningful ticket there, and thus a meaningful interface towards the VC as an LP. And I think that's a big if or a big point that you're making, Crispin. You need to have someone internally that knows how to work with that VC, knows how to interface in a way that a VC can interface, and know what to ask and what not to ask. Because otherwise you'll very quickly, as you said, be just turned into a cash cow, and you'll try and do the minimum that will allow you to get the next ticket. Or maybe you'll even say it's not worth it, right? I can't do this.
And taking a little bit in here, and Andreas, right? I think if you are a corporate and want to do it, it's a matter of setting the expectations, even from the GP side of things, right? What are the deliverables? What can you expect in this collaboration? Because that's super important, right? It's like when you invest into a startup from a GP, what is the expectation? What is the communication level? How much? How little? Because otherwise it's going to be successful.
And I think, but there's one very interesting avenue that I think has suddenly become open by the LLMs, which is that those reports that you spoke about before, that would require immense analytical work to do on the whole incoming deal flow, that can be done rather efficiently now by even a one-person GP, and that's definitely a flow of information that you can give to a corporate partner that would likely be incredibly valuable, which you in no way could have ever have delivered before. That was the purview of the very large firms to be able to service a corporate like that.
Maybe just one more point about just circling a little bit back to the CVCs. Maybe one more point about, like I've mentioned before, a couple of points, what might help or what might not help when a corporate wants to set up a CVC. And one thing that is, I think, also something that is not sort of majority knowledge, or we actually have decided to use an evergreen setup. That's in the VC world. Of course, that is sort of not the typical VC setup with these like 5-year investment period, raising the next fund, and so on. Over the years now, I've seen that this model has huge advantages for a CVC and also for the partners of the CVC and the co-investors. Why? Because with the evergreen approach, and with evergreen I mean that, like, of course, you're like a fund. You take the money, you draw down the money when you need it, you invest it in the startup. When you do the exit, you give it back to the corporate, but you have the right to redraw it. All of it, part of it, that depends on the setup, but best is, of course, all of it. What is the big advantage? When you set up the CVC, what the board of a corporate really doesn't like, if you're coming back every couple of years and say, I need more money, I need a new commitment, or I don't know what, the corporate is used to closed-end business models. Either the business model is successful, then it's growing and it's nice, or it's not successful, we close it down. That's what a corporate is doing every day. And with an evergreen, you can do exactly that. So you can say, okay, I need this one commitment in the beginning, and then afterwards we grow or we shrink, and I have to fire my people. But it depends just on our own success. And sort of this closed setup, I think, was, especially for more conservative corporates, is much easier to grasp, because if they think, every couple of years we need to recommit or do I don't know what, that's more difficult, especially for the second fund, I think, because as we mentioned before, you need the second fund commitment after 5 years. Probably you don't have paid back the whole fund yet, so it needs an additional commitment. So there the evergreen has a lot of advantages. And what I've learned over the last years is also, in the beginning, I thought the evergreen could lead you to less exit pressure, but at the end of the day, it's more, because all of a sudden you're not like a VC fund who has some companies are not performing so well, but your incentive to sell it is zero, because, well, there's still an option value in it that it might turn around. But if I sell it, the money's gone. I can't reuse it. But in the evergreen, you can reuse it. So your benchmarking and really sort of pressure on, okay, so the ones that are not performing so well, you will not wait 7-8 years to sell them. Actually, you will do it earlier, and because you can redeploy it into other opportunities. So there's a lot of advantages, and another advantage is you're always on the buy and sell side at each point in time, so you see the market quite well, what is going on. So there's many advantages. So I at least wanted to mention that one.
I think it's an excellent way to do, portfolio management, right? To make sure that you have the right incentives, right? Because you also mentioned that on earlier, Crispin, about this, make sure that you have enough money to do follow-on rounds, yes, right? Because otherwise you'll be excluded from the ecosystem.
Yes. And the way how we are dealing, for example, with other VC funds that we invest in is we tell them when we do the first fund commitment, we are an evergreen. So if you do well, we are your partner, not only for this fund generation, but also for the next one and the next one.
Guys, we are getting close to the end. We've run for a super long time. It's been incredibly engaging. So, I haven't been wanting to control the conversation too much, but I do want to make sure that we make it to the future of CVC, talking a bit about the trends and predictions. I realize it's going to be a bit of a quick fire format here, but Francesco, I'll let you go first. If you should give us your core takes on what we have coming for us in the CVC space.
Sure. So I think some of them have been already mentioned. So I'm going to mention again quickly. So one is basically looking at CVC from more like a core business value creator as an initiative. And in that sense, the venture client model would probably, be more primarily observed and adopted, or at least explored. Going back to the core is very important, especially in kind of tough times like the one that we're seeing now. It's a short economic cycles. So core business goes back as a lion. CVC probably will look at a venture client, in a way to align with that goal. Second is, I think, the use of the flourishing of more intermediaries, right? So we know these platforms like a Plug and Play or Touchdown Ventures, right? I think more intermediaries of that kind, not necessarily platforms, will emerge because deal sourcing is a problem, right? Is a challenge at the very least for a lot of funds. So I see intermediaries for this, improving deal sourcing will be something that I will see more. The other one is about the governance, but I'm not gonna push more. I just want to make sure that one of the things that I continuously hear from a lot of units is the not invented here syndrome. So the systematic rejection of solution brought from outside, from people that are in the CVC unit bringing solution, and then the R&D people, they say, but I didn't ask you to bring anything, or this is not really what we do, how we do. So that usual story that if we incorporate, I think that is something that bringing in the operations more in general, creating governance across different level is very important. And finally, I would say what we've been discussing from the very beginning. So CVC is just one of the corporate venturing initiative, the integration on a portfolio of different initiatives. So if I have to if I have to nail like a mosquito, is different if I have to bring in down an elephant. And so I have to use different type of tools for that. So I think the reflection of between and within CVC corporate venturing strategies will be a fundamental trend that we're observing and more in the soon future.
I think we will become looking much more like the American corporations investing. So my belief is intuitive that there will be more and more CVC entities across Europe. It is also my dream, and that is why I do what I do, right? That's also why we are doing this show. But it is to make sure that C-suite get an understanding of how to use this strategic tool. And it's very, very important. We have more and more startups in Europe. We have more and more real businesses in Europe, the Spotifys, the Klarnas, and so forth, right? We will have more and more talent coming out of that understands how to work with startups. So, I believe in a European success story, also on the CVC side.
And then I jump in, and let's be bold. So I would say pure strategic CVC approaches will disappear. That doesn't work. All the reasons we've mentioned before, especially you're getting a selection bias for founders, and it doesn't fit to the co-investors. So to the VC investors or to the institutionals, it doesn't fit. So second, and that's also, I guess, no surprise, I think the Evergreen Model will gain in popularity. The reasons I've said before. Overall, I do hope and also strongly believe that the overall weight of CVCs in the total VC community, it has grown a lot, and I think it has still some potential to grow more. So if I have the numbers well, I think right now it's around 25% of total 25% of total dollars invested. I think this could go also to 40-50% over the next years. Because it is just so important for each and every corporation to play it, the larger ones. And well, finally, and I think this fits perfectly to what Francesco just said, I do believe there are very specific different innovation tools, and the corporates that understand these differences and really decide which ones are the right ones for them, and maybe combine 2, maybe even 3 of these different tools, while CVC is one of them. They can use these sharp approaches, and they will be successful. So I think this is the best way to go.
Gentlemen, this has been an incredible episode. So I'm so thankful that you all joined us for it. I really think that this has been one of the very best we've done. So, or maybe it's just because it's a topic that I'm much less well versed in, something that I never scratched the surface of as much as I did here. So guys, thanks so much for joining us.
Thank you for the
invitation.
Here's a few words from our beloved sponsor. HowToWebConference is the leading startup and technology conference in Eastern Europe.
You're shitting me!
The 2024 edition takes place on October the 2nd to the 3rd in Bucharest.
You tell him I'll be there!
You can enter the most electric space for doing business and building technology in Eastern Europe. There you'll find 3,000 plus international attendees, 500 plus startups, 200 plus investors, 100 plus global speakers, and infinite possibilities to connect and get inspired for your next move. Venture funds joining include Creandum, Atomico, Northzone, Seedcamp, Cocoa, 3VC, Startup Wise Guys, Salesforce Ventures, Common Magic, and many more.
It's a lot more than 10 guys.
HowToWebConference also hosts Spotlight, the early stage startup program and competition for Eastern European founders, gathering the sharpest founders in the region. See you there.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
United and determined, we can serve as a model for other regions of the world.
The nature of a problem requires a European response.
Europe is a story of new beginnings, new beginnings.
Let's start acting.